Emergency investor warning. A new Berlin Wall is going up, and the shock of this decoupling is only just beginning to be felt. The US is now banning all Russian energy except uranium, although we're getting some new headlines in the last half an hour that they may ban that as well, which the White House had kept resisting until the last minute. The EU announces it will diversify from Russian energy as soon as possible. This is really important for one of our big positions. This will involve rejuggling global energy supply chains. And this could very well likely take a full year to complete. The EU plan is to launch a massive new Eurobond to pay for both its new energy security and its defense spending, which crosses a fiscal Rubicon in that defense spending is going to be a multi-decade commitment, not a one-off package. So more debt, more QE coming out of Europe and China as they try to reroute energy supplies, which is going to be very good long-term for Boyle, one of our big positions. So we're going to be holding that a lot longer than we anticipated. And that's really what's taking so long for Boyle to boil up. They've got to reroute these purchases. The EU is also flagging potential outright price interventions in energy markets. Pete Buttigieg yesterday says, don't worry about gas costs, just go buy an expensive electric car. China announces it is considering buying into the Russian energy and commodities sector with firms like Gazprom and Russell, likely targets, which will infuriate the West. The US Commerce Secretary says Chinese companies that defy sanctions against Russia may be essentially shut. So this would be potentially banning semiconductors to China. Okay, so we're seeing how important the de-escalation of this little conflict is going to be in the coming weeks and months. Russia announces it will restrict some raw material exports, with details of to whom and to what to be made clear in 2 days. So, they control important metals for semiconductors, they control wheat, and they control natural gas and oil. So no big surprises in who they're going to target. And this is all rolling out right now because NATO refuses to back off the border of Russia and has gone full nuclear, imposing the SWIFT ban on the central bank. So Russia is completely decoupling from US financial system. And it doesn't look like they're going to come back anytime soon. So Mr. P has no choice now but to go full-blown war. His reputation is on the line. There was not an immediate threat. This is all about making Russia great and Mr. Putin's legacy. So we have a little bit of a calm with these peace talks today, and we get this big relief rally in stocks. If Ukraine does not surrender, I think we're going to see all hell break loose within the next 2 weeks. The Russian currency is collapsing, but they've done a pretty clever little currency control like Turkey did, and it did jump back 50% today. So that was a big move. Meanwhile, the Russian stock market's imploded. It's down 85%. It's not clear if it's a smart investment today. The second we think there's a de-escalation, this would be a great way to get energy companies on the cheap. For now, we've been watching this with interest as it trades at 565. We've got JP Morgan, of course, the big ugly banks buying up Russian assets on the cheap right now. They call it the smash and grab. So very tempted to get that play in there, but we're being a little patient because I don't think we've actually hit the pitch fever of how bad this is going to get within the next 2 weeks, I'm expecting now. And again, I was wrong. I thought Ukraine would surrender last week. And of course, this is just getting worse and worse by the minute. So really, the reality is if peace talks fail, chaos is likely to ensue very soon. And I'm thinking next week. So it's important to protect your wealth and be safe during this period of time. And also, we have an inflation print coming out tomorrow. The White House is already coming out saying it's going to be bad. Of course, they've given out false data on jobs data previously, but I honestly wouldn't be surprised if the CPI is pretty hot tomorrow. We'll talk about what we're expecting and how we think the markets will react based on if it's above or below our expected inflation print. And then the next week, we get the FOMC decision. How many interest rate hikes is Mr. Powell going to bring to the table? And probably they're going to hike interest rates either 25 to 50 basis points, and then probably do some sort of collaborated effort to crash oil and take claim for that. So we'll see how that plays out. But this is our March 9th, 2022 investor update. Those are the highlights. Our top selling advisory is now up 7% in 2022. We were up as much as 14%. Most investors are getting slaughtered this year, down 10%. If you're lucky, most investors are down much more than that. This exact same strategy with the exact same philosophy returned 233% in 2021. A lot of the gains happen in very short periods of time, and that's the way markets work. So if you didn't have your position in crypto yesterday, you didn't wake up to a massive jump in Bitcoin today. Also, very odd, we're seeing the larger market cap crypto go up higher than the altcoins, which is a great sign for altcoins, but just typically not the usual move. So we've got Bitcoin up 8%, Ethereum up 4.5%, and then our favorite altcoin, Polygon, only up 3%. So very unusual, but this was all from the executive order from Biden. Looked positive for cryptocurrencies. So let's take a look at how we would invest $10,000 today. If you have $20,000, double these numbers to 100,000, increase it by 10. If you do upgrade to our paid membership, you have a software platform where you can punch in how much money you have to invest, and it will print out exactly how many shares to purchase. So we've been sitting on the same pile of crash insurance, UVXY, for quite some time, and it has really ballooned to about 17% of the portfolio. I don't think the time to sell it is today. I'm afraid we're likely going to see a dramatic escalation this weekend and next week, as Russia is now regrouping, resupplying, encircling Kiev, and getting ready to probably take it over by next week. Now, I got to say, Ukraine's been surprising me with its successes. And so maybe this takes a little bit longer to unfold. But now we do have Zelensky saying they're willing to make a deal. The second they make a deal, we want to get out of UVXY. I just don't buy it's happening anytime soon. So UVXY has gone up about 75% this year for us, protecting against downside risks. But we really haven't had a complete panic in markets. And so that still could be in the cards. We will have to just wait and see. We're completely protected against an outright crash. In March 2020, when we had a black swan event, which we did predict for members in early February, it took a while to create the panic. But when it panicked, boy, oh boy, did we get that huge 34% drop in a month in the S&P 500. UVXY went up 1,100%. So again, a 10% position was all you needed at the start of the sell-off to completely protect against all downside risks. Think about it. If you had 10% going up 11 times, if the other 90% of your portfolio went to zero, you're still making a 10% return. So it does well in absolute market crashes. Here's a look at that chart. This year, it's down 10% today. And again, we don't recommend you build the portfolio out separately, build the whole thing at once. It works as a unit. Each position protects the other position. UVXY goes up if the S&P 500 goes down. And typically S&P 500 goes down when people get margin calls, they go bankrupt. Okay, so some recent moves this week that had some pretty extreme market volatility was just about every futures contract went limit up, and anyone who was hedging or shorting those markets lost billions of dollars Monday morning. And so there's a big nickel giant out of China that was just bailed out by JP Morgan, just hit the headlines. So think of UVXY as your bankruptcy hedge. If people go bankrupt or lose more money than they have, it forces them to start selling everything in their portfolio to try to stay alive. So that's why you see systemic selling in some of these events. And so that's certainly, the signs are there. You need this protection in your portfolio. I'll be willing to completely dump it out the second we get a significant de-escalation and diplomacy with Russia and Ukraine. At this point, highly doubt that's going to occur, because Zelensky won't give up an inch of Ukraine to Russia, even though they're talking about changing the constitution to not allow them to join NATO. So this is the crash insurance play UVXY. Now, our favorite position over the next decade is to go long a cryptocurrency called Ethereum. I think of it as investing in basically Microsoft before it was even 10 years old. In fact, it's more like 7 years old. So this is an operating system that is very successful. It's growing rapidly, and it's going to basically rebuild the entire global financial system in a decentralized manner. It's been incredibly successful. Its market cap is only at 300 billion. Without question, this asset could easily grow to several $trillion in the next several years alone. So we're looking at no less than 10 times your return on ETHE over the next 5 to 10 year period. And the more governments want to print money they don't have, the more governments want to weaponize money, the more talk about a digital dollar, the more this space is going to grow. So everything we're seeing happening with Russia getting banned from the US system is going to further push people into this. Add in global inflation and food inflation throughout the Middle East, South America, and Africa. Everything is setting up absolutely beautiful for this particular position. So we like ETHE. You can buy that in your stock trading account. It's a grayscale trust, and it's actually trading at 30% below value. So you can outperform buying Ethereum at Coinbase in the next up move by buying ETHE. So right now, for every $10,000, you're picking up 211 shares. Now, Ethereum, since 2017, so just 5 years ago, is up 19,000%. And recently, it's pulled back 43%. Okay, these assets, cryptocurrencies, have 50% volatility all the dang time. It's completely normal, and it's really the rare opportunity to go load up. So our strategy essentially is to help investors have exposure to our favorite growth asset this decade and hedge you against the key risks, which again will be margin calls, which creates stock volatility, or inflation, which ends up creating bond market volatility. Volatility of either type is dangerous for an asset like Ethereum that's such a small market cap and just getting its feet on the ground. So we recommend you build the whole portfolio out and hedge the bond market by going long natural gas. So 95 shares of BOIL completes your whole portfolio. Right now, it's just 3 stocks that does the whole job. Now, BOIL is going to do really well as Europe starts to stop purchasing so much gas from Russia and has to buy it from you know who, North America, which is what will make BOIL go up. So for those of you following the program are upset that BOIL has not kept up with NRGU as of recently, well, hold on to your horses. It's really getting the perfect catalyst. And again, they're believing this could take slowly but surely an entire year to reroute these orders. Also, during rate hike cycles, natural gas has been the single best performer the last 2 times the US was going into rate hike cycle, which it absolutely is, and China expands its credit. So this is a critical position to protect your Ethereum. Here's a look at that chart. We've seen BOIL as high as 55 this year while we're holding it, crash back down, jumping back up. And again, the only thing that would scare us out of this position in the short term would be diplomacy between Ukraine and Russia. Other than that, this is a great play, and it does not look like any diplomacy is in the cards anytime soon. Let's look at it in a table format so we can see it all put together. Currently, we have a 17.6% UVXY position, which is massive. We would love for it outright stock crash to happen tomorrow. I don't see it happening tomorrow, but if it did, we're going to make a ton of money and we're going to buy the dip because here will come quantitative easing round 5. And that could be what this whole war is about, trying to create a travesty, an economic disaster, so they can go back to quantitative easing. We'll see. But right now, we have nothing to worry about at this massive hedge. The second we see diplomacy that's realistic and de-escalates these sanctions on Russian energy, we got to get out. UVXY needs to be dumped. So we're hanging on to it until that occurs. And so far, it does not seem like it's happening in the next week or two. So yeah, Putin must come out of this with a victory, and he's really been pushed into a corner. He has no choice. There's zero chance he's going to back down without a victory at this point. Okay, the sanctions are beautiful for Ethereum. The more you want to screw around with people's money and control the world with it, the more money is going to get out of the system into crypto. And again, we like Ethereum the most. It easily makes 10 times your return by buy and hold over this decade. We're not in NRGU. I'm expecting a pretty significant crash in oil. The second this de-escalates, we're probably going to see China and the US dump some of their strategic reserves. Maybe Biden will allow the drillers to start getting going here. Maybe they open Keystone. But one way or another, they've got to get the inflation down before midterms. So I'm expecting a big crash in oil soon. We'll be ready to play that with ticker drip. I don't think now's the best time to short oil, but I do see a big crash from 125 oil, which is at 110 today, probably sinking down to 75 to 80. That's when we're going to go big time into NRGU. So right now, Boyle makes the most sense. That's the one that's not been rerouted yet. That's the one that has a lot of upside potential for us. So we remain with this current positioning of 17% long UVXY, 84 shares, 46% long Ethereum with 211 shares, 36% long Boyle with 95 shares. Now again, what you want to pay attention to is the number of shares. You're not paying attention to the percentage asset allocation. That's going up and down every split second. So just by 84 UVXY, 211 ETHE, 95 Boyle, sit back, wait for your next trade alert. I'm studying this constantly to know when it's safe to take away the incredible hedges for Ethereum and go full-blown aggressive on that side. Now, when a de-escalation occurs, assuming it does, expect energy costs to fall rapidly. And this should cause bond yields to fall. And so we can see one way or another, these oil prices are not sustainable. So the next trade alert we're going to do probably will be to short oil and then take the profits from shorting oil and go big in Ethereum. So a 1-2 punch. Also, I'd like to pick up some Russian energy companies, pennies on the dollar. Okay, so China's doing it, JP Morgan's doing it. I do not feel bad doing it either. But we're going to be a little more patient because this conflict looks like it's unfortunately nowhere near resolved. Here's a look at the bond market. So we've had this huge sell-off. If this is going down, that means interest rates are rising. We're at a critical support line. I really don't see interest rates rising from here unless the inflation just goes out of control over the next 6 months. I think the bond market's basically priced in all the inflation we have currently and is looking for a relief rally for the rest of the year due to a slowdown in the economy due to no fiscal stimulus now for well over a year. But the food input and the energy inputs are the wild card. And if we don't get those costs down soon, I'm gonna have to recalibrate my expectations of the Fed and the bond market and what impact that's gonna have on our portfolio. So the 70s is really the period we wanna be worried about if inflation doesn't come down to what's expected. So we'll talk about what's expected as we get to the CPI data later in the presentation. For now, though, it's pretty clear the global economy is slowing down rapidly. The rates that have risen have been overdone. And so my expectation is essentially yields are going to fall for the remainder of the year or trade flat. And then we're going to moonshot cryptocurrencies and the Nasdaq. and that until we get a full-blown economy roaring again, that we need to worry about the next rising yield problem, which will probably occur with more stimulus in the US. So I'm looking for a short relief rally in the bond market, which will moonshot your Nasdaq and your cryptocurrency positions. Here's that Nasdaq getting beat up this year, just the same as last year. So last year from December through March, the bond market crashed and it took the Nasdaq and Bitcoin down with it. The rest of the year it rallied. It was your best performing asset class. Okay, we just had a complete repeat this year. And so as long as we get those energy costs down, I'm highly confident those will be the best assets this year as well. Now here's a look at that Ethereum chart one more time. You're getting it at a huge discount from its recent peak. And again, I see this market share going from 300 billion to 3 trillion easily once you really comprehend what this does. Okay, it's a very massive project with huge opportunity. Now, I also want to point out the last time the US tightened, which means hiked interest rates and let the balance sheet run off, so they didn't reinvest the bonds. What happened? China expanded as the US tightened. Okay, that's exactly what China is doing right now as we're about to tighten. And in general, bond yields rise over time during a tightening cycle, making those bonds unattractive. And it forces investors into anything except bonds. And so Bitcoin went up 4,400%. Okay, that's not a double, that's a 43 times return. It's insane. So I'm not saying we're going to get a 44 times return on Ethereum over this next 2 years, but to tell you it could double, triple, quadruple is really not out of question. Now the market cap back then was tiny compared to today. So that's why I'm not forecasting such a remarkable move. Now the catch is, as soon as the bond market's interest rates get too attractive relative to inflation, money flies into the bond market and the rate hikes stop occurring, and you tend to get these different crashing environments. So this chart looks great for Bitcoin, but if you didn't know what you're doing and you didn't pay attention to what was happening, the next move on this was a 80% collapse. So we got to be very mindful of the bond market, of inflation, and when those two are going to become a perfect match, and then get out of the way. In general, once interest rates are catching up to the inflation rate, you want to get out of the way. So at this point, the interest rates are at 2% and the inflation's at 7% and running higher. So it's not a good time to buy bonds, probably for about 2 years is what I'm estimating. Big picture is global economy slowing down. And if energy costs fall, inflation may peak by March. I think everybody's going to start recalibrating this to June because the conflict is being extended much longer than we initially thought. So the longer this drags on with Ukraine and Russia, the more problems we're going to have with bonds and inflation and energy costs, which again starts to hit the bottom line of corporations and the consumer. So these energy costs are a big, big problem. And if this war does go on for a long time, we're going to have starvation, we're going to have price controls, we're going to have all kinds of crazy stuff happening. So I'm prepared to now recalibrate my peak CPI to hit June before we really start to see it falling, depending on, again, when energy costs fall. So for now, cash is trash. Europe's going into a money printing spree to boost up its energy security and its defense, which it's not been spending money on whatsoever. And bonds are still garbage. The inflation is not coming down anytime soon, and interest rates are extremely low. So investors have no other logical option for the time being but to buy stocks, cryptocurrencies, commodities. The commodity move is really overdone. Okay, so I'm getting ready to pull the profits off of that and bet big on the stocks and cryptos in our portfolio. Specifically, very bullish on tech stocks and Ethereum and Bitcoin. And again, all we need for the catalyst is get those energy costs down. Now, we got midterms coming up. The number one concern of voters globally is the inflation. So you better believe they're going to do something to get those commodity costs down before midterms. So I believe it's highly, highly likely that we're going to see a value to growth rotation. We've been doing the opposite. We've been betting that the value or energy would outperform, and it did go up higher than I expected, but we made a massive gain on that. Now we're predicting a reversion, and that this reversion will likely last into midterms. And perhaps the next catalyst to reverse that again would be a big US fiscal spend. So they've switched from Build Back Better to Build America Better. That's their new brand name for the new spending package. So that's why it's critical you watch our webinar every Monday, Wednesday, Friday, and be ready for sell alerts. Now, if you're on a free trial, you're going to get the entry, but you may not get the exit. So it's important you take advantage of 3 spots available per day by calling Dean at 505-322-7515 and upgrade your membership so you gain access to the private membership area. So this is where you can punch in how much money you want to invest, and it'll print it out. We have 2 strategies, the high risk, which is what we're covering in the intro today, and then the safe growth, which is where we give you a global stock portfolio that's playing the largest markets in the world. Okay, very good. Let's go ahead and jump into the content. And we'll read some headlines, and I'll look at the chat box. Let me check out the chat box really quick. Okay, very good. Let's go ahead and jump into it. So I think I've covered all the stuff we've talked about in the chats. US weighs sanctions on Russian nuclear power supplier, Rosatom. Move could impact nuclear power industry. So that headline sent URA up 5.6% today. That's a position in the safe growth strategy, about 3.5% of our portfolio. Uranium explodes on Russian ban chatter. They're pointing out the GOP wouldn't pass $4 billion for Trump's wall, but they're ready to shoot $14 billion off to Ukraine. So the war is bipartisan. Both parties are all in on it, and it really shows you this is more of a one-party government here in the US. Bloomberg Economics dropping an inflation bomb. We now project the February CPI to show an increase of 8% year over year and top out in the vicinity of 9% in March or April. But if energy prices continue to rise, CPI could rise above 10%. Okay, so we're looking at a different CPI number, which is about 1% lower than this one. But that's pretty similar to what I'm expecting. And we'll look at that exactly on the chart when we get to it, which comes out tomorrow. China state funds ordered to buy stocks yesterday to contain rout. So China's getting ready to go into a credit expansion as the US is getting ready to tighten. And almost certainly the Republicans will take the House and maybe the Senate. And we'll go into a very much smaller spending package, most likely, if any spending at all, as we split the government into gridlock. So we'll see how that plays out these midterms. But the Democrats might try to do anything possible to spend some money this year if they can get Joe Manchin on board. China once again urged the US to make a comprehensive clarification of its biological military activities, both at home and abroad, and accept multilateral verification after the US-run biological laboratories in Ukraine have been arousing extensive attention. So we got like Mark Rubio saying that Russia's going to do some sort of bio attack on themselves as a false flag attack or something of this nature. So, you know, what are the biolabs doing in Ukraine on the border of Russia? Who knows? But that's currently being used as potential false flag material by both sides. Jen Psaki says tomorrow the inflation number, we expect a high headline. McDonald's says quitting Russia. So they're just getting out of Russia, leaving all the stores behind, costs it $50 million a month. White House says U.S. has never opposed Poland giving planes to Ukraine. So there's a bunch of talk about these planes getting over to Ukraine, causing some volatility. Oil drops more than 10% after Ukraine says it's prepared for compromise with Russia via Bloomberg. Also some headlines from Middle East that they're willing to increase output by about 8%. Jurian Timmer says inflation raises a big question for asset allocators. What this will do to the correlation between stocks and bonds. History shows that bonds are inversely correlated to stocks during periods of low inflation. And so the main history lesson here is that from the 70s, while they did go up and down at different times, overall stocks and bonds both went down and gold went up for a good decade. So if the inflation doesn't fall, we're basically facing a problem for bonds and stocks simultaneously. So we really need, and with my best guess, inflation to hit 3.5 by the end of the year and get back down to 2.5 by the end of next year for a Goldilocks situation where the stock market just takes off and there's not tremendous pain in the bond market. If we get this inflation running too hot for too long, bonds are going to crash and take stocks down with them. And that's the lesson we learned from the 70s. And it would also make the Federal Reserve hike interest rates very, very aggressively. Last time this happened was with Paul Volcker. So he has a good chart, basically says when there's too much inflation, bonds and stocks start to trade correlated and in general down. And again, 3% inflation we can handle, 4, 5, 6, 7, 8, 9, 10 we cannot for very long periods of time. Mark Rubio says many in the West still don't understand Putin is an expert liar. He doesn't care about humanitarian relief. If, in fact, there's a ceasefire, it's because he sees some strategic or tactical benefit. So it's just going on and on. Zelensky's saying they're capturing their military equipment and using it against them. We now have Canada freezing bank accounts, US freezing international reserve assets, the LME canceling trades that hurt their brokers and the futures commodities markets. Things are moving fast. The rule of law is breaking down in our financial system. Not good. All a big sales pitch for crypto. Okay, in this chart, Jurian Timmer of Fidelity saying, what can we expect moving forward for asset allocation? This chart offers some clues. And so in general, he's predicting a value over growth over the next decade, that we're going to see emerging markets over US markets, which is exactly what I am expecting. But as you know, in this next 9-month period, that's not what I'm predicting. We're predicting that we're going to have the Nasdaq and tech stocks go up and commodities have a relief, and that this will be very politically important that this occurs. So over the next decade, I completely agree with that. Over the next 9 months, absolutely not. And we were betting the value over growth last year and did very well with it. Here's your discount on GBTC, Bitcoin, and ETHE, 22% discount on Ethereum, 27% discount on Bitcoin. So in our safe growth strategy, where we own Asia, Europe, and US stocks, we own uranium, we own rare earth metals, and we own Bitcoin. So GBTC is at a huge discount. I'm getting ready to go big on that for the safe growth strategy. In the high risk strategy, we're going to the second largest cryptocurrency asset, Ethereum. It's about 1/3 the size of Bitcoin. And that's where we're really placing our big bet for that portfolio over the next 5 to 10 years. Oil dumps on comments out of Iraq being able to produce more if needed. 14 days since the invasion, here's where the war stands based on latest US assessments. US estimates of Russian military assets lost or inoperable range as high as 8 to 10%, close to double the estimate last week as the US has gathered more information. US estimates the Ukrainian military has lost a similar percentage of its forces. These estimates mostly account for losses on military equipment, aircraft, tanks, APCs, and trucks, since they are easier to verify with confidence. U.S. estimates Russia has lost somewhere between 2,000 to 4,000 service members, though this assessment comes with low confidence. U.S. does not have reliable estimates of losses for Ukrainian personnel. On the battlefield, Russian forces have advanced more quickly in the south, less so in the east and north, though they continue to surround or attempt to surround cities in the north and east. U.S. believes Russian forces are still several days from being able to surround Kiev, and afterward would face a protracted battle to control the city center. As Russia advances have stalled, it has increasingly targeted civilian population centers, a trend the U.S. believes will worsen following Russia's playbook in Chechnya and Syria. At least 474 civilians, 29 children have been killed since the invasion began, according to the UN Human Rights Office. Further, 861 people have been injured, and believe these figures are likely actually higher. We're opening Pandora's box by restricting exports and companies pulling out of an entire country like it's no big deal. Sure, let's threaten China now. China could bankrupt Amazon overnight if they wanted to. Kiev mayor says if Russian encircles the capital, we have resources for only a week. And so that looks like basically Russia's strategy is encircle Kiev, take over the power plants, and then force them to surrender. So this could all play out in the next few weeks. And the big question is, assuming there is a success, will Putin take a relief and reestablish some resources, or is he going to go immediately to expand to a few more countries, which the main goal is to secure their borders, which Russia's been attacked 50 times in the last several hundred years. Tracy Chigirl says the Federal Reserve is about to hike rates into 1, a war, 2, a global slowing economy, 3, with energy prices exploding. To say they're behind the bar is an understatement. This is a big thread that, there's this big push for clean energy vehicles. The catch is to power the energy for the electric vehicles, we need coal. And to dig up all the lithium and nickel for the batteries, we need oil. So we want to be long all those assets for the next decade, and we sure are in both of our portfolios. Okay, Live Monitor says top 3 November midterm issues, all voters. 1, inflation, 88% are concerned. 62% are very concerned. 2, violent crime. 3, election integrity. So I think what Biden will most likely focus on is for sure the inflation. They got to get these energy costs going down. But what are they doing about it? So far? They're just making it worse. So I don't quite understand their game here, but perhaps it will become more clear as the weeks proceed. China accuses U.S. military of operating dangerous biolabs in Ukraine, which is comical considering the biolabs in Wuhan. BlackRock hedge fund upped its Russia bet, suffered record loss. The Biden administration and Fed plan to crush oil after the FOMC, which is March 15th through the 18th, to take credit for, quote, solving the energy crisis that they are trying to blame on Putin. Fact is, they amplified it from the beginning. So, what if we get a resolution diplomacy within the next week or two and simultaneously hike rates, and then also have all the countries dump some of their strategic reserves, announce the U.S. is going to open up the Keystone. So there's a lot of things they could do simultaneously and just crush those oil prices, which will be our opportunity to buy the dip on NRGU. They're going to go up, President Biden says when asked about gas prices upon his arrival in Texas. Asked what he can do about it. He adds, can't do much right now. Russia's responsible. China has ordered refiners to halt exporting gasoline and diesel in April. So the setup for oil is getting better and better. We should have been in RGU first, longer. But I believe that move is basically done, and the big money is yet to be made in natural gas, where we're still long. So, to everybody who's upset, we only doubled your money on energy when we could have tripled it. My apologies. Definitely sold us way too early. But I think we'll make up for it with the Boyle play. And there's no expectation to change that play until there's diplomacy that's significant and energy bans on Russia are reversed, which may not be happening anytime soon. So we got to keep watching that. Scott Mindert says mounting inflation pressures and a recession risk will corner the Fed. If market turmoil rises, flooding the system with liquidity could erode its inflation fighting credentials and send long term rates spiraling upward. But failing to act could lead to a systemic financial crisis. The market may just like a few rate hikes to get these inflation expectations down. Probably nice, slow rate hikes will be very market friendly, which is what I'm expecting. Great thread here. I completed my doctoral thesis at Oxford last year on Russia's military interventions in Ukraine and Syria. Based on that research, I'm sharing some thoughts on why Russia invaded Ukraine and what Putin might do next. Russian military interventions are often explained by geopolitical opportunism or regime insecurity. It is intriguing that Russia would invade Ukraine when its great power status was rising and there is no immediate threat to Putin's regime. Geopolitical opportunism has been chronically overplayed. Russia's annexation of Crimea and Black Sea foothold was not rationally worth the cost of Western sanctions. Even in Syria, Russia embarked on a potentially high risk, uncertain reward mission that ended up succeeding. Regime insecurity has also been exaggerated as a driver of Russian aggression. The 2011 to 12 protests might have influenced Russian alarmism about Euromaidan and the Arab Spring, but there is no serious threat of unrest diffusing from Kiev and Cairo to Moscow. Putin has instead used military interventions as a tool of legacy building and identity construction. He is focused on long term legitimacy of his regime and Russia's political system. Hence, he is willing to take excessive short term risks and incur geopolitical costs. Putin's legacy hinges on satisfying domestic great power status aspirations. This means having a sphere of influence, effectively challenging the US legal order, and having a superpower style global reach. The image of greatness matters even if Russia is actually isolated. Putin has also deftly framed his military interventions as a triumph against long-standing perceived internal threats. Fascism, uncontrolled unrest, Western expansionism, Islamic extremism. These narratives date back to Hungary of 1956 and endured through the Soviet collapse. Putin has also effectively rationalized the cost of military interventions to the Russian people, highlighting Russia's capacity for self sacrifice as a contrast to perceived Western decadence is crucial. Hence, the continuous World War II Great Patriotic War references. The war in Ukraine allows Putin to showcase Moscow's control over its sphere of influence, willingness to combat socially accepted threats, and feeds into popular conceptions of Russian strength. It is an identity construction and authoritarian consolidation project. There are two differences between Russia's current and past actions. The first is the extent of Russia's willingness to take risks in support of these goals. The second is Putin's readings of public opinion. He is appealing to a core base rather than the public writ large. Putin's conduct suggests that he will continue the war in Ukraine until he achieves a success that he framed as a legacy or identity construction win. Given his framing of the war, that likely means he will continue pursuing regime change, but not necessarily an occupation. Given this calculus, sanctions are unlikely to deter Putin, and diplomacy is unlikely to change his mind. Only an intra-elite schism, which poses an immediate threat to his regime, might cause him to recalibrate, and even then, most likely only temporarily. The period between World War I and World War II was merely an intermission, and so is the period between Cold War I and Cold War 2.0. Russia's war marks the bifurcation of the global system as a systemic rivalry between the US and China, Russia in strategic domains, commodities, defense, space, and technology. So in other words, this could be the start to a much bigger problem if things are not resolved soon, especially if China starts to take Russia's side here, which so far they haven't. Funny post from Elon. He puts Samsung, Toshiba, Nakamichi, Motorola. If you look at it, Satoshi Nakamoto, the creator of Bitcoin. Russia has warned that it is working on a broad response to Western sanctions that it claimed would be swift and felt in the most sensitive areas. So cutting off natural gas would do the trick. Russia may launch commodities war on the West, unleashing food crisis in the MENA region and around the globe. So that's what we have to look forward to if this is not de-escalated very soon. Jim Rickards, Biden's orders work on a digital dollar, CBDC, and cryptocurrencies. This has little to do with technology or monetary policy and everything to do with herding you into digital cattle chutes where you can be slaughtered with account freezes, seizures. So the digital dollar would allow the Federal Reserve to halt money without having to interact with any of the US banks. And it is coming in. China's is already here. Risk markets are flying higher. Aid to Zelensky says Ukraine's ready for diplomacy solution. Ukraine aid can discuss neutrality, needs security guarantee. But this statement is key. Does this mean Crimea? Ukrainian aid won't trade a single inch of territories. Jack Posobiec says they're going to tie this biolab stuff to the no-fly zone. Screenshot this. Coinbase blocks over 25,000 wallets for being Russian. Okay, so DeFi, got to get your money out of Coinbase, guys, into your private wallets. Kremlin says United States has declared an economic war on Russia. We're yet to see their response, their retaliation. So that's what's coming next. All right, that's my key headlines before we look at charts and economic data. Let's see if there's any questions I haven't answered yet. We've got Tom saying, go Rebel, go. Yep. Yeah, we've got biolabs all over the world, guys. It's people asking why we have them in Ukraine. They're all over the place. All right, so the darn 2 years going up again. So we're looking at the 2-year, 30-year. I'll zoom out a little bit. So when they talk about the yield curve inverting, that means the long end will have a lower interest rate than the short end, which means you're going to have too much inflation. The Fed has to hike interest rates to get inflation down, but it's the economy is too unstable for that. You're going to crash markets and GDP growth. So the problem is when they cross over and then they steepen, and then you get a crash about 16 months. So as you can see, the space between these two is getting smaller and smaller. The one we're particularly interested is the 10-year and the 2-year. So look at how close they got right here. Starting to spread out a little bit again. So it's going to be exciting to see how the bond market responds to rate hikes. Gary says, why should we get out of Coinbase? Because they're starting to confiscate crypto due to government instruction. So put it in your Nano Ledger S or your MetaMask. Don't store it at Coinbase in general. Kraken, same thing. The Kraken CEO saying, get your money out of our centralized exchange. The government demands we seize anybody's crypto. I mean, your crypto could have somehow crossroads with some Russian's crypto, and all of a sudden your crypto gets locked up is kind of the problem. Okay, so here's the yield curve collapsing. The 2-year almost pays out the same interest rate as the 10-year. So this is called a flattening of the yield curve. Not good. Not good at all. So let's see if some rate hikes and getting energy costs down can spread that out. We want that to spread out if we don't want a market catastrophe. All right, the probability of a rate hike is only 25 basis points for the first event. And Powell went into the Senate and testified that's what we should expect. So I don't think we're going to get a surprise 50 basis point hike. If we do, that would be fascinating, and I'd expect some volatility in potentially stocks and bonds. Okay, reverse repo jumped back to 1.5 trillion. We call this the quantitative easing buffering. It's extra free money sitting at the Fed to help markets out. And so as soon as that starts to drain, we'll get worried about interest rates rising. Here are some of these energy products that we're looking at. So we got Boyle, NRGU, USO. So USO spot oil, NRGU is the big oil and gas companies in the US, and Boyle's US natural gas prices. And so my expectation is the big opportunity to make a lot of money in the next 90 days or less is going to be on Boyle, and it's going to be on Russia striking back where it hurts against everybody who's been sanctioning them. And the only thing they can really do to hurt everyone is cut off natural gas and oil. And the sharper they do it, the faster they do it, the more pain will be felt. And that's where we're likely to see the big spike. Right now, Russia is just trying to get as much money as it can, and they're selling their gas and oil at a 30% discount to anybody who's willing to take it. John saying, if I have money at Kraken, would you recommend? Yeah, I would say ETH is a safe place, or you could go to Rebel Dividends when we have everything off the centralized exchanges as well. So you might want to reach out to Dean about Rebel if you want me to do that for you, John, or go to ETH. If you're mainly in Ethereum, ETH is a better deal. So unless you're doing what I do, which is I take the money, convert it into Ethereum, I go to Aave, I take a loan against that, so we're actually able to take $1 and give you $1.50 worth of exposure and have a huge cash position to buy dips. So unless you're going to take advantage of Aave, there's no sense in buying Ethereum, the real deal, because you get it at a discount safely out of your stock brokerage account. Grayscale Trust bought all of its Ethereum in one swoop and put it in a cold wallet and then made it a stock. So I don't think we need to worry about the government seizing Grayscale Trust Ethereum in terms of ETH. Okay, so yeah, so we're disappointed Boyle hasn't gone to the roof with all this escalation. But so far, Europe keeps buying natural gas from Russia, and Russia's not cut it off. The big move is going to be as they start to divest from Russian natural gas. It's going to have to come from the US, and it's going to make those prices go up. And if Russia wants to get nasty and cut off Europe suddenly, you're going to get one of those crazy spikes higher. So a little patience here with Boyle, please, everyone. But it's done well. It's not like we've not been making money on Boyle. So if we just go back and look at the chart this year, Boyle's up 30, let's say, from the 10th. We got Boyle up 30%, USO up 33, NRGU up 67. But Boyle has the opportunity to double, triple, quadruple. Okay, so and again, it doesn't look like this is going to de-escalate anytime soon. Okay, we got that dump in oil today. A whole host. I believe oil is going to go much lower before we want to buy NRGU again. Here's gold, copper. If we zoom out a little bit, not a big signal. So if gold's going up faster than copper, we're expecting interest rates to fall. If copper is going up faster than gold, we're going to expect interest rates are going to have pressure to rise. And so these two have been trading pretty much lock in step. If we go out to this far, to the start of 2022, they've been going pretty much the same pace. Both are going up. but we have a 10% return in gold and a 4% return in copper. And again, gold really shot up during the escalation of this war. So up until the 24th, when Russia officially invaded, they were pretty much lockstep. You could see gold had an idea it was coming, but it was really in the last 2 weeks where gold shot up an extra 10%. Now copper did too, but it pulled back viciously here. Okay, Baltic Dry Index. This is telling us maybe the inflationary pressures are slowing down. Very important for how we're positioned. That's cost of commodities between continents, shipping rates. Here's a look at the, zoom out a bit. So in general, interest rates have gone up. In this chart, the yellow represents leveraged long interest rate product, up 21%. NRG went up 91%. Nasdaq's down 16%. Our basic forecast is the interest rate rise has been greatly overdone in the short term. Interest rates are going to stay flat or fall. Energy costs are going to come down. And we're going to have growth outperform value until more stimulus is coming to the table. And no stimulus is coming to the table until that inflation is falling rapidly, or there's some sort of crazy geopolitical event that creates extreme problems. In this chart, we're looking at Russia stocks, ETF RSX, and the price of oil. And let me hide the interest rates. So there's a huge opportunity, but too dangerous right now. So I want to go long Russian stocks, short oil at the right time, soon as we see a resolution. So that would probably be Ukraine surrendering to Russia is really the main catalyst to make a move. And so we can buy drip to short oil, and we can buy RSX to go long oil at an extreme discount. And those two together could be a beautiful trade setup. Okay, here's emerging markets against the Nasdaq. We got headlines: China's buying their own stocks. So far, emerging markets is not outperforming the Nasdaq over this period. If I go to here, it is. So from the start of 2022, emerging markets are down 9%, while the Nasdaq's down 16%. And so in safe growth, we're getting big on emerging markets. Okay, Russell 2000, we're not invested in. We're just watching to see it not crash, to believe that a stock recovery is in the works. And so far it's doing its job. It's trading highly correlated to interest rates in yellow. Europe had a big jump today. So you can see that big jump up, about 4% jump in European index. We have exposure to that. They're going to have to do a lot of money printing and keep interest rates low with QE. So we're going to see expansion of debt and quantitative easing extended in Europe and Asia. So we're very bullish on Europe and emerging markets or Asia over this coming cycle compared to US. But again, in the very short term, I think you get your best return in the Nasdaq, US tech, and of course, Bitcoin and crypto. DXY pulled back a little bit today from, I think it was at almost 99 yesterday, currently trading at 98, and boom, you get your Bitcoin jumping. A price I believe we will hit over the next 12 to 24 months will be 90 on the DXY. And again, it could take a good 2 years to hit that. And that would be when I'd want to jump ship off of crypto, off of stocks, off of commodities, and go big on the dollar and big on treasuries. So that would be where interest rates have gone to peak prices and the dollar has lost value relative to European currencies. And again, that could take a very long time. So our current positioning could do very, very well for what I expect to be the next 2 years. Chinese currency just sitting there nice and strong, getting stronger by the day. If this is going down, it is strengthening. So China can certainly print some money. Here's some of the tech volatility relative to interest rates. You can just what we're now seeing is a delay. So when the interest rates are rising, we're now seeing the Nasdaq sell off like 2 days later, which is odd, but that's a pattern I've been picking up on. So if we zoom out a little bit, see some of these big mega tech giants peak drawdown. We've got Nvidia down 29, Tesla down 26, Amazon down 22, Microsoft down 15. Rock says, why not go purely into MCHI? Because we can get 3 times leverage emerging markets with EDC, and I want the whole area with leverage. So it's 4,000 companies you have exposure to. Beautiful product, EEM, but times 3 with EDC. Okay, in this chart, we're looking at Taiwan Semiconductors, Taiwan, the big chip producer, really the last key technology China needs. There's no chance they're going to take Taiwan right now, so don't even worry about that. But yeah, so far they're trading extremely correlated. I think the signal to go even bigger in emerging markets will be when we see Alibaba and Tencent greatly outperform Taiwan Semiconductors. Because if I zoom out a bit, we can see this huge discrepancy in returns. So from peak, we can see Alibaba's down 62%, Tencent down 47, with Taiwan Semiconductors down only 23. So I'm expecting Alibaba and Tencent to outperform Taiwan Semiconductors as soon as China really gets aggressive with money printing. Bounce in Toyota after it had been selling off. This has been probably the best performing stock with a large market cap coming out of Europe and Japan, which we have exposure to in the safe growth strategy. Peak drawdown from the top was 24%, a little bit of a bounce of 4% today. And again, these problems with Russia are causing problems for car manufacturers and chip producers. Here's Exxon going straight up over this year. Peak prices were back in 2015 at 104. We're at 82. I'm expecting to see a pullback due to getting oil costs down for midterms, and then that's where we're going to jump into NRGU again, which the biggest position is in Exxon. Here's the yield curve over time. So the signal is you invert the yield curve, then the long end interest rates rise rapidly, and then you get a stock crash. So from inverting, it's like a countdown for about 12 to 16 months to a stock crash. So we're getting ready to invert here any month now. So we'll see. But again, that's not the time to sell your stocks. That's when the bond market may collapse, force people into stocks, and then you get the big crash. Here are some bond markets, more volatility in the TLT, unfortunately. So let's keep a close eye. So we've got a little drawdown in the TLT, 1.3%. Let's see if we have some volatility Friday or Monday in crypto and tech. That's been the trend lately. Now it's not a huge sell-off. The most recent sell-off was a 3.5% decline in TLT. That created some pretty significant volatility right here. Look at that drop, boom. And then a few days later, we had the volatility. Now, good news is the stock bonds are going up. So maybe we don't get that volatility. Because in this drop, we also had the LQD and the TLT crash at the same time. And then a few days later, we had that volatility in stocks. This is the Tesla to Ethereum comparison. They don't always trade the same, but they're highly correlated. And so from this point, we could see a huge potential jump higher for Ethereum. So the main catalyst would be a cool off in the bond market, and energy markets is what we need for that to happen. Here's your gold and silver just kicking some ass and taking names this year. Stagflation is the main trade. We're seeing a very interesting opposite correlation to gold from Bitcoin. So a gold Bitcoin strategy could do very well during a highly inflationary period. And if the CPI is not going to fall to Goldilocks levels, perhaps gold and silver becomes very attractive. So I'm getting more inclined, especially with this sell-off today, to look at opportunities to get us into gold, into our portfolios, to balance out our crypto positions. So far, we've not made that call. Here's the leverage treasury play TMF. In general, I think this has bottomed out, same as it did last year. So we had a crash from December to March, and then a rally all year. And then we had a crash from December to March, and now are we setting up for a rally all year? And if so, we want to be exposed to, again, the Nasdaq, Bitcoin, and Ethereum. Okay, so long term, we need energy. We need it in every form we can get. Our plays for this are copper miners, rare earth metals, uranium. We're not in copper miners because I look at rare earth metals as a more aggressive copper miner play. So we're really using rare earth metals and uranium outside of either oil and gas or natural gas to give us exposure to raw materials needed for energy over the coming decade in our safe growth strategy. So if we zoom out, you can see these have been tremendous money makers from 2016. You go back a little further, not so much. So you got to be careful about the cycle you're coming into. Here's another look at the yield curve. And it is ugly. So it's steep, it's the yield curve's flattening. So the long end is going down, interest rates are falling, and the front end just keeps going up relentlessly. The 2 years, typically what ends up dictating what the Federal Reserve will do in terms of rate hikes. So far, the 2 years priced in 6 rate hikes. Now, here's what they want it to look like. And we'll see if rate hikes start to basically push the long end up and the short end down. So this is what they want. Last seen October 2020. What happened? Trump did $1 trillion stimulus. Biden did $2 trillion. And he created an inflation nightmare that they cannot put out. And so it's causing the yield curve to flatten, making the 2 year go up while the long end doesn't do nothing. And this spells disaster, but again, not till much further down the road. So in general, if they can start to get the yield curve looking like this, we won't be so pessimistic that we're headed into a recession in 2 years. If it keeps shaping up like this, we're going to be worried that we're on the verge of a stock crisis in about 12 to 24 months. Here's your VIX terms structure. It's set up to skyrocket higher or fall fast. So good time to buy the stocks at a discount today and hedge with UVXY. And so UVXY is down 5% today, but on the stock side, we had SPY, which we have 3 times leverage to with UPRO, went up 2.7. We've got the triple Q, which the QQQ went up 3.6. We've got EDC for emerging markets, which returned 2.8% today. We have EFO, which is 2 times Europe. That puppy went up 4% today. So we had an 8% gain on that. So the hedging's expensive right now, and you could get clobbered on that UVXY position. But it makes it worthwhile when you simultaneously buy the stocks. And so the second we think the risk in the market is resolved through diplomacy or surrender, we will dump the VIX and buy Bitcoin, Nasdaq, Ethereum. Okay, here's this move today that's kind of odd. Let me zoom out first. So typically, if Bitcoin goes up a little bit, Ethereum goes up more. Let me try to get a good picture of that highlights this. And this has really become more apparent recently than prior. It's been hard to outperform Bitcoin over the last decade. Most altcoins have actually gone to zero. Very few have survived. In general, though, the larger the market cap, typically the less volatility. So we like Bitcoin, Ethereum, and Polygon. And we're expecting to get a better return over time on Polygon, then Ethereum, then Bitcoin. And now sometimes the large cap makes the move first and then the altcoins follow after. And that's what I'm expecting now. But in this jump today, zoom out a bit, Bitcoin outperformed everything and Polygon's slacking. So we'll see if that trend continues. We'll update this on Friday. But I would expect for Ethereum and Polygon to leap ahead in the near term and outperform. So we'll keep a close eye on that. All right, core inflation data. We're looking at this one, not the one that has those higher readings. And so I'm expecting it to hit 6.5 tops. If it goes above that, maybe some stock volatility and maybe some bond volatility. In other words, TLT and SPY going down. If it comes in below 6.5, I would expect the TLT and SPY to both go up. And so that's really what I'm expecting here. I'm expecting it to also peak out in March and fall into April if energy costs come down. If they don't, then we need to perhaps look at inflation running hot for longer and potentially creating stock crash sooner. So this needs to go 6.5, hit 7, and then fall. I think the market's okay with that based on oil prices going negative in March. So by April, we really should see the CPI falling. If it's not falling in April, we've got a big problem. I don't think bonds or stocks are going to like it, and the Powell's going to have to start doing really aggressive rate hikes. So we'd want to be long the dollar, not treasuries, not stocks, and not crypto. So UVXY and the dollar could very quickly become our only two positions if this inflation data does not cool off. And the key here is get food, energy costs down before March. If we don't see those falling by March, then there's zero chance that we're going to see this fall, the CPI print. And the CPI print comes a month later. So we really need to see these costs cooling off in March and falling rapidly into April to believe that we're going to have the type of prints. So the print coming out tomorrow is February's. So we'll see how that reads out and give you an update on Friday. Producer price indexes globally seem to be slowing down, especially in China. So as long as, again, energy costs come down, I'm not too worried about that one. Non-farm payrolls, we're adding a lot of jobs. So that's going to put pressure on the bond market. We've also got wages rising, pressure on the bond market. Labor force participation rate rising. Now, is it going to rise indefinitely like we had from the 70s to create this really bad stock return? Or is it going to top off and slow down? So far, that's yet to be determined. Right now, there's more jobs open compared to people looking for a job than I think in many decades. So this could keep rising. And again, that'd be bad for the bond market, good for commodities markets, bad for tech stocks. So banks are lending. A surprise crash in consumer credit. So the savings rate's really fallen, and people are expecting this to go off the charts, but very little credit added in January. We'll see what the February print looks. Meanwhile, the retail sales jumped. So after a down month, it flew back up. So the U.S. consumer remains very strong, and consumer spending hit a new record in January. No reason to freak out that we're going to have a earnings slowdown in corporations. Now, to be bearish on the dollar long term, we want the government to run big deficits. They call it the twin deficit. So United States balance of trade hit a new record low. We imported more than we exported at a record level. So we're shipping dollars off much faster than we're bringing them in. Meanwhile, we're printing money or borrowing money faster through expansion of debt. So for a 2-year plus period, without major conflicts, I'm expecting the dollar to fall. And once it hits that DXY of 90, we're going to take massive profits off our crypto positions and bet the dollar goes back up. All right, so tomorrow is, I believe, the very last print that we should expect this to rise. We'll see where it ends up. $8.9 trillion today. And so now we're entering a completely new period of time in monetary policy. So we're expecting about 2 years of rate hikes, and at some point letting this balance sheet start to fall. Okay, so it's the same policy you saw during Trump's term starting in 2016. So stocks did well, bonds did poorly, crypto did excellent. ECB is probably going to keep printing and expanding debt with what's happening in Europe, and that's good for stocks. Okay, so that is the core of our presentation. We're about to go to exact asset allocation for both strategies. If you're not a paid member, you're about to get kicked out. Upgrade now, call Dean. There's 3 special spots at 505-322-7515.